Thank you. Now, I hope everyone's had lots of coffee this morning because we're going to tackle one of the industry's big issues. Is it time to ditch the risk profiler? Now, just to gauge the sentiment in the room, can I just get a show of hands? Who loves risk profiling? Who dislikes or hates risk profiling? A couple of people. Who thinks it's time to ditch the risk profiler? Most people. So given the sentiment in the room, why do we persevere with it? As it turns out, ASIC actually doesn't mandate that we do a risk profile. All ASIC wants to know is that you know your client, that you know the product, and that you know their outcome. But unfortunately, the best tool that we have to basically tick off all of those things is the risk profiler. So given that we're stuck with it for the moment, I think it's really important that we understand, I guess, the flaws of the process. And there's two major ones. The first one is that risk tolerance is not rational. And the second one is that risk tolerance is about the outcome or the purpose and not about the person. So to illustrate these 2 points, it's worth just walking through the process, which goes something like this, and you guys know this very well. You're having a meeting with a client, it might be the first or the second interview. You're getting to know each other, you're having a nice chat, and you're walking through the fact find. And it gets to the point of the risk profiler. That point where you get to ask half a dozen, maybe more, completely arbitrary questions that the client's then meant to respond to in a concise, considered, educated way. Now, the reality is that most clients don't actually have the education or the understanding to answer these questions rationally. The other thing is that it's going to depend on what they heard on the radio on the way in or what they read in the paper this morning. If you're walking into an interview and you're working through these arbitrary questions, and in the cab or in your car, you've heard stories about $50 billion wiped off the banks in the morning. Or you've read an article in the newspaper in the Herald Sun, I'm from Melbourne, talking about $2 trillion wiped off global markets. What's your risk tolerance likely to be compared to if you'd been in that same situation maybe 3 or 4 months ago when the markets had actually risen 20%? Very, very different. So then, having answered these questions, they go into a magic black box and it spits out an asset allocation that's meant to solve all of the world's problems and give them exactly the answer they need to get to the objective that they're reaching. The problem is, and as many of you would know, that there is usually a complete mismatch between their risk tolerance and the risk required to meet their objective. So for them to retire comfortably might require them to be a balanced or a high growth investor when in fact, because of the conversation they've had with the cab driver on the way in, they've come through as a very conservative investor. So then they have to start taking shortcuts and you have to look at ways that you can basically ratchet up their risk profile to make sure that they can reach their objective. And that really talks to that second point. That risk tolerance depends on the purpose or the objective, not the person. And for anyone that's moving to more of an objective-based financial planning model at the moment, you will well and truly understand this issue. So let's not be completely harsh. There are some pros to the risk profile, and as I said, it gives you it identifies the appropriate asset allocation model. It looks at the risk required to get to that objective. It looks at their risk capacity, so how much they have and how much can they afford to lose. And it looks at the risk tolerance, so if in the event that they do lose money, how are they going to feel about it? The cons, however, are that it doesn't identify their literacy and their education needs. Okay? Are they actually in a position to answer those questions? Do you need to hold their hand? Do you need to spend a lot of time educating them on basic principles? Or are they already got a PhD in economics and know most of the theory? It doesn't identify their desired engagement or communication needs. Is your client going to want to log on to the web and have a look at their portfolio on a daily basis? Are they happy just to get the annual statement at the end of the year from their super fund, look at the balance and put it in the bottom drawer? Do they want to be constantly communicated to? And it doesn't identify their investment preferences. So it doesn't identify if they're interested in active management, passive management, tactical asset allocation, strategic asset allocation, some of those things. And this one's a really interesting one because there is also a big gap between your investment preferences and how you like to run portfolios and how your client might want to run their portfolio or what they might be comfortable with. So given all of this, we've got a problem. And as part of a much bigger brand project that we're doing at Net Wealth at the moment, we needed a far better way to understand our clients who are ultimately your clients. We needed a process that was easy to implement and easy to understand and gave us answers to some of these questions. So to do this, we engaged a company called The Lab to look at a new way of understanding and approaching our clients. The lab's one of Australia's leading ethnographic and brand strategists, which basically means that they study culture and people. And they've worked with some of the biggest brands in Australia, from banks through to the AFL and Medibank. And we set up a war room with them, which looks something like the one on the screen. It had lots of post-it notes and scribbles. And we started talking to a whole heap of people. We spoke to advisors, we spoke to advisor clients, we spoke to direct clients, so those that don't have an advisor by choice, and we spoke to what we call PACs, or previously advised clients who had an advisor but have removed that advisor for whatever reason. And as we were speaking to them and working through a whole range of different questions, we started to see clusters of information or clusters of responses form around their behaviours and attitudes to money and finance. And we were able to plot them onto what we call the Customer Needs Framework, or the CNF for those that like a good TLA. And what it does is it divides Australians into 4 really neat segments. The beauty about the Customer Needs Framework is that it's really easy to implement into your own business. And as I start to sort of do a deep dive and walk through this process, you'll start to get a picture of the type of clients that you have and where they sit on this matrix. So it's easily incorporated into your own business. It's going to help you better understand your clients, educate your clients, communicate with your clients, and ultimately engage with them from an investment needs perspective. It's going to overcome some of the gaps that we've identified in the risk profiling process, but unfortunately, as I mentioned, we are stuck with the risk profiler. So it really is an overlay or a second dimension to what you're already doing. So having looked at the clusters of information around the attitudes and behaviours of our clients, we started to build personas. And the first thing we looked at was literacy. So this is the horizontal axis. As you know, literacy is the ability for a client to understand the financial products and structures and determine if it's going to meet their needs and objectives. Now, the thing about financial literacy is that most Australians, unfortunately, haven't had the opportunity to learn about money. Our schools are absolutely appalling when it comes to financial literacy and increasing our clients' knowledge of wealth. So from the start, we're not able to really have a good grasp on what we need to do. The other thing is that not many people have the time to learn about financial matters. Some people just simply don't have the inclination. Some people don't have the time or the inclination. And a lot of people just haven't had the opportunity to experience it. And this experience is really important. So you can have someone that's done a PhD in economics and might have a perceived very high level of financial literacy. Now, if they've never had the opportunity to experience loss or have never experienced investing money, they're going to have a very different perspective to those that have. In Australia, a study done by the OECD about 5 years ago, but it won't have changed a lot. And they basically asked Australians, how did they rate their financial literacy? And they asked them basic questions. And the first one was compound interest. Do you understand compound interest? 67% of Australians said, yep, absolutely. That's a fundamental money management item. When they were then asked to do a problem using compound interest to solve it, only 28% could actually do it. It's a bit scary. So it just shows that big gap between perceived financial literacy and actual financial literacy. I mean, compound interest really is a foundational piece. One of the respondents from the survey, aged 38 with a young family, said, I think a big part of success in wealth management is actually taking an interest and taking some responsibility for your own financial destiny. I wish I'd taken more of an interest in finances earlier in life. So that's a classic situation where the inclination wasn't there and they've left it too late and now they're looking to increase their literacy. The other axis is resilience. So this is the vertical axis. And resilience is the ability to set long-term goals and stick to them. So this is about being able to roll with the punches. This is about being able to bounce back from failure. This is about grit and determination. A financial planner that responded to our survey said, overcoming failure takes courage and courage ultimately breeds success. I think that's a really powerful statement. And that's clearly someone that has a high level of literacy and a high level of resilience. One of our client respondents, age 47 with an older family, you need to set yourself long-term goals to reap the rewards of your investments. So already just from that statement, you can see here's someone that has a high financial literacy, but more importantly, they've got a long-term focus and therefore a high resilience. So when you look at these two axes and you start to plot clients based on their attitudes and behaviours, you get these personas. And the first one are the aspirers. So they've got a low financial literacy, but a high resilience. And many of you will have aspirers in your existing client bases. And aspirers are looking for you to show them a brighter future. You've got the explorers, a fantastic financial planning segment, harder to manage, but these guys have got financial literacy that's very high and they've got high resilience. They're typically professionals that have had a good, successful career and they understand hard work. The disengaged, and we were struggling to come up with a name for this category, Unfortunately, these type of clients are really wanting you to hold their hand, and they're more likely to need a life coach. They've got very low literacy, very low resilience, and you're going to find them in an industry fund or a MySuper product. And the Mavericks we're going to spend very little time on. These guys want shortcuts to success, and they're just basically dangerous. So the aspirers, let's do a bit of a deep dive. They're demanding transformation. They want transformation, and they're wanting you to show them a brighter future. To inspire them, you need to show them what they can achieve if they put in the hard work. They're wanting support. So they're happy to put in the hard work, and they're happy to read and learn in their own time, but they want to know that there's a safety net. So they want control. This is a typical coaching relationship. And they're wanting you to educate them, to share knowledge that will empower them to become better investors through the long term. Now, I've put a picture of a young bloke up there. The one point I really want to make about this is that aspirers and all of these personas are completely agnostic to life stage, to risk profile, and to gender. So you can have a accumulator that's an aspirer, you can have a pre-retiree that's an aspirer. It really doesn't matter. It's more their attitudes and beliefs and behaviours to wealth. To wow the aspirers, you need to empower them to take greater control. They want a clear financial roadmap, one where they can see the objectives, they can see the timeframes, and they can see what they're working towards. They're looking for tailored financial education. They're looking for self-learning tools and calculators. They're looking for regular feedback. So that comes back to that earlier point around engagement. You need to talk to them and say, do you want to touch base every month? If you're doing cash flow management, do you want us to send out a report every quarter, every 6 months? How often do you want to be involved? They're looking for clear and simple reports on performance versus objectives. They don't care about correlation. They don't care about attribution. They just want to know how their investments are performing and how they're performing to their objectives. And they're looking for transparency, both in fees, so what you charge, what the products they're invested in charge, and investment performance. They're interested in things like ETFs, managed accounts, where they get to see the underlying investments. And whilst the top 20 ASX product is probably not the best place to be invested at the moment, it allows them to see the stocks that make up the top 20 and then read articles and become better educated about those stocks and see how they behave to different market conditions. In the States, there's a site called Betterment, which many of you would have heard of by now. It's one of the fastest growing online robo-advice tools. And it's been hugely successful with this segment, with the Aspire segment, because for a number of reasons. One, it's online and it's got a real focus on simplicity. As you can see from that one screenshot, it's basically got everything you need to know. Very simple portfolio selection that is based on outcomes and objectives. And you can see up in the top corner, there's a drop-down box that says build wealth. That could be save for retirement, could be save for a new car or for a holiday. And then it builds a portfolio that's automatically rebalanced around those particular objectives. They send out regular email tutorials around a whole range of topics that are related to that particular objective, and they're big on goal setting and tracking. So successful has Betterment been with direct clients that they're now teaming up with some of the world's largest institutions. And the first one to sign a deal was Fidelity, and they're now rolling it out through all of their advisors for the fact that it is so simple and reflects what aspirers want so well. Great quote from Think Advisor. Betterment brings new investment management services to an entirely new generation of client. So that's not Gen X or Gen Y or millennials. It's the type of client that's looking for this type of information, this type of access, and this type of relationship. The next segment that's worth focusing on, the explorers. So they're demanding transformation, and they're wanting you, as the advisor, to help them see things differently. When you're communicating with explorers, these guys are very established, they've got high resilience, high financial knowledge. You need to be measured, you need to give smart responses, and you need to be really clear and methodical. They already acknowledge the need for hard work when it comes to investing, so they're not looking for shortcuts. But they're going to be difficult to keep. They've probably got a multitude of advisors. They probably speak to their accountant regularly, their lawyer, they might have a stockbroker and a financial advisor, and they're looking for tailored thought leadership. These guys read the AFR. They probably get Alan Kohler's newsletter and a host of other newsletters. So if you're simply forwarding on articles that they've already read, you're going to lose their attention pretty quickly. So you need to be constantly challenging their ideas and helping them progress their thinking. They're looking for a broad range of broad access to investment ideas and investments. That doesn't mean they're looking for complex products or structured products. They're just looking for things that they might not have considered before that are going to better help them reach their financial outcome. They're looking for personalised and curated business and economic news. So again, looking at what they've got in their portfolio, the type of structures that they've got in their portfolios or the asset classes they might be exposed to, and challenging them on why they hold any of those things. Typically they'll be in an SMSF or a super app, And they're probably wanting things like attribution and correlation because they understand it and it's of interest to them. Great quote from one of the respondents, aged 45, with an older family. I will never stop reading and expanding my knowledge. I would say that after a number of years and stumbles, my abilities these days are better than any time in my life. So from that statement alone, you can easily plot them on that graph. So you can tell they've got a high resilience because they've made mistakes, they've learnt from them, they've experienced loss, and they're constantly reading and looking to improve themselves. Whilst it's no longer operating in Australia, Ubs Private Wealth, good example of a service that is tailored around these explorers. Overseas, they do a fantastic job of constantly producing thought leadership pieces, whether it's about macroeconomic views, political views, asset class views, whatever it might be. But they're always taking a different view on what you might read in the main newspapers. Disengaged. Look, unless you have a highly automated program to service these guys, it's going to be very hard to build a business around them. And they might be better off in that MySuper or industry fund product. And the shortcuts to success, just get rid of them. Okay, so that's the theory. So how does it actually look in your practice? Hopefully as I've gone through that, you're already starting to place your existing clients into the boxes. I don't know, most of you have got A's and B's clients, maybe 160 to 200. You should know them pretty well by now. And if you don't, there's a number of really simple questions you could ask, as you've seen throughout the last few slides around, how literate are they and how high is their resilience. So what we're going to do is we're going to run through a bit of a case study. It's a very quick one. We're going to look at a hypothetical family of my friends based loosely on the respondents. We've got Ben, who's the dad, Christine, the ex-wife and the mum, Chloe, the daughter, and Stuart, the older boyfriend. So Ben's a baby boomer, he's 59. He's got 2 older children, including Chloe. And he's a dentist contemplating retirement. He's pretty progressive. He uses Skype on his tablet, or he might even use it on his 6S phablet, or he might even have a look on his watch, which his kids gave him. He has a large nest egg because he's a dentist. And he's been investing for a long time, so he's an experienced investor. He said, when younger I was looking for high growth. Now I'm a touch more conservative, but I'm always looking for new ideas. So he's starting to plot him already. He's probably up the resilience curve and also along the literacy curve. Christine, the ex-wife, she's a baby boomer and she's celebrating her freedom. She's finally got rid of Ben. And the kids have moved out. She's living the moment. She's a marketing manager and she has more time than she's had in ages. So she's going to the gym, she's going out with the girlfriends and entertaining. Now, because she's always left everything to Ben, the experienced investor, her view on investing and her experience of investing is very different. Her view is that without risk, there are no rewards. She probably has enough to retire on, but she doesn't actually know. Her view, I've worked all my life, what do I need to worry about? Life is all about today. Chloe, 27, tech and social native, so she's grown up in the internet age. She's got really low levels of trust with authorities. She's a very independent thinker. She's a software developer, and her hero is Evan Spiegel, who started Snapchat and now goes out with Miranda Kerr. She's purchased the NASDAQ 100 because it's an easy way for her to get access to all of her favourite tech stocks, including Facebook and LinkedIn, despite it falling 44% last week. She understands that super is her money. And she gets that investments are for the long term, and I like the idea of ETFs, but I don't really know what else I can invest into. Stuart, also divorced, unfortunately, 2 kids at uni, and he's a lawyer. And he's actually built up a really successful firm. So he's a professional with grit. He's happy to set long-term goals and he's happy to work hard for them. But he's very time-poor. And when he's not with Chloe, he's on his bike and his lycra on the weekends. He has an SMSF for his paintings, which hang on his wall. So clearly he doesn't have a great idea about investing. And he lost heaps during the GFC. And he's a little jaded. He wants to leave a legacy for the kids, so he's happy to have another look. So when we start to plot the family on what I call the risk profile life stage dance floor, we get this outlook. Ben, who's the protector. So he's got his nest egg and he's wanting to grow it for retirement. He's no longer high growth, he's more conservative, so he's a balanced investor. Got Christine. I've got enough to retire. She's a consolidator, although she doesn't really know what that means. And she's high growth because she's got no real experience of loss because Ben's always done it. Chloe, she's an accumulator at the start of her career and she's a balanced investor. And Stuart, who again is trying to consolidate and leave something for the kids, but given his experience during the GFC and the fact that he's extremely jaded, he's a very conservative investor. So they're all scattered all over the place. When we then plot them onto the customer needs framework, we get a very different picture. All of a sudden, Stuart and Chloe are in the same quadrant. So they've got low financial literacy, but they've got very high resilience, so they're aspirers. And they share a lot of common values, which is probably why they're going out with each other. You got Ben, very high financial literacy and high resilience. So he's an explorer. He's wanting you to help him see things differently. He's got a good grasp on investments. And Christine down in the disengaged box. Unfortunately, she's got a long way to go. Now, the next guy isn't part of the family, but he's worth just reflecting on. Mr. Arrogant, he's the perceived high financial literacy, but very low resilience. And he knows everything, but if you have something exciting, let him know. You know, these guys are day trading, they're flipping properties. You're never going to be able to keep them happy, and when things don't go their way, there's potentially legal action. Okay, so now that you've started to plot all of your different clients into these boxes, a really easy way to see what sits in your client base is it's 2 columns. All you need to do is put in one field for resilience and one for literacy, and then just add in high, low. Once you've done that, you can then pull all of that data out and plot it against your revenue, your fees, or your FUM. And you'll be able to see where there's clusters of clients. So you'll be able to see if the bulk of your business is actually aspirers, or explorers, or disengaged, or mavericks. And then you need to have a look at your service offering. Does it actually match what your clients are looking for? And if not, how are you going to reinvent the service proposition to match their needs? Or are you going to look at a different type of aspirational client and start to build a new service proposition around the aspirational clients and not your existing clients? So I'm going to pause there for a moment and join you in a couple of minutes, but I'm going to invite Nick Hakes up onto the stage just to give a bit of a wrap up this morning. Thank you. Thanks, Nick. So this is the part where you guys get to do a little bit of work. So this is the business canvas. And the reason we like the business canvas is because it's a bit like the one-page business plan. It's a really quick and easy tool where you're not expected to go into lots and lots of detail, but really just break down your big ideas into the little small parts that make it possible. And the reason it's really important to fill out a document like this is that no doubt many of you have got lots and lots of ideas. How many of them are realistic, I don't know. But in any business, you need to then take the ideas and prioritise those ideas to see which ones you're going to implement. So unless you actually know what's involved in the big idea, you can't possibly prioritise them. The other thing is that ideas are worth absolutely nothing unless you execute them well. And no one understood this better than Steve Jobs, who realised that execution is worth millions, or in his case billions, despite the many brilliant ideas that are out there. And the equation there is just sort of basically saying, if you have a great idea but really poorly executed, you're going to make nothing. If you have an average idea that's brilliantly executed, it's worth something, and if you have a brilliant idea that's brilliantly executed, you're going to make the millions. Some examples of great ideas that didn't get executed so well: Prohibition. Great idea, healthier America. As we know, all it did was create an underground scene that meant more Americans actually got drunk. Google Glass. Has anyone ever seen anyone wearing Google Glass? It's only happened once, and it was really creepy. The guy was sitting opposite me on the train. I didn't know what he was doing. I didn't know if he was photographing me. I didn't know if he was looking me up on Facebook. Didn't know if he was checking his emails or videoing me. It just wasn't a good experience for me, and I don't know what it was like for him. iSnack 2.0, I think we all know what happened there. The Apple Newton, well before its time, badly executed. The Segway, that was meant to revolutionise personal travel. Now, the only time you see these is doing city tours, or maybe at the Australian Open. And my favourite one is Pink Beer. Swan Lager over in WA had been doing a whole lot of market research. And they realised that there was a huge gap in the market for beer for women. So they created a pink beer, and they created warehouses full of the stuff. Problem was that women weren't going to drink pink beer, and there was no way that blokes were going to drink a chick's beer. So they've still got warehouses full of the stuff. Okay, so how does the business canvas actually work? So I just wanted to prove that this business canvas can be used by big businesses, but it can also be used by small businesses or medium-sized businesses. So I picked a really simple example to run through. So this is Kelly's lemonade stand. So this is what Kelly needs to do to basically sell lemonade. The first thing is, and if you could just make little stars around a couple that are particularly important, the customer segment I'm going to give you. But the customer segment for Kelly, so who are the most important customers, are park visitors, young families strolling through the park. Value proposition, this one's a key. Just make a little star, whoever's scribing on your table, because you really need to start here. What is the service, product or bundle which solves a specific customer need? In Kelly's case, it's cold, tasty lemonade on the go. And I have no doubt that it's also organic and sugar-free. Customer relationships, how is she actually going to sell her lemonade? Because she's in a park and it's homemade lemonade, she's going to do it personally, face to face. And she's going to do it via a booth. So she's not selling it on the internet or in a shop, she's doing it via a booth in the park. Revenue streams, just make a little asterisk next to this one as well. How's she going to make money out of this big idea? Being lemonade, she's going to make money from the lemonade and also from tips. So she's got a personal channel selling via the booth, and she's hoping that she'll build that relationship and as a result get tips. Key activities. What's she going to need to do to sell lemonade? She's going to need to make the lemonade. She's going to need to market the lemonade, otherwise no one will know she's there, and she's going to need to sell the lemonade. Key resources to making the lemonade are the ingredients, booth and equipment, and she's got ideas of grandeur, so apparently she's going to need lots of salespeople. Who's she going to need to work with to make sure that she can set up her booth and sell the lemonade? She needs to speak to the local council. You can't just set up a booth in the park. And in our case, obviously, it's going to be the regulator. Cost structures, what's going to cost to make and sell the lemonade? Equipment, ingredients, flyers. She's going to put flyers around the park so that everyone knows that her lemonade stands there. And the sales commission to pay the hundreds of salespeople that she's going to put on. Is everyone quite clear on that? Any questions? No? Okay, so what the exercise we're going to do now for about 15 minutes is we're going to build an investment proposition and a service around the aspirers. So this is the group or the segment of Australia that's looking for you to show them a brighter future. And this has been a key segment that people in Silicon Valley have been really focusing on. And whilst I'm not going to go through all of these particular companies, it's worth having a look at them in your own time. LearnVest sold to one of the large mutual banks in America for around $250 million recently, after 6 years of operations. It was started by a young lady that realised that Americans needed a cheaper way to invest. When you log into LearnVest, it presents you with progress boards, there's online learning, there's regular tasks to help you become a better investor or saver or a retiree. Wealthfront has become the go-to robo-advisor for Silicon Valley. Bloom helps you manage your 401k or your super fund in America. And Vanguard, the not-so-quiet achiever, every 2 months they are raising more money through their robo-advice service than every other robo-advisor in America. They've already accumulated about $30 billion in the year and a half or so that they've been operating. And they're very focused on this aspirer segment. So low cost, clear, easy to understand with a real focus on education. Aspirers like all of these services because they're easy to understand, very clear and focused on the objectives and outcomes for the client. And they offer that interactive coaching that we spoke about earlier in the education. They're transparent and simple when it comes to pricing. It's important to note they're not necessarily the cheapest product. Don't forget aspirers are happy to pay, but they want to understand the value that they're getting. And they're not necessarily the lowest risk products because they'll change depending on the risk profile of the client or the objective outcome of the client. So before you get stuck into it, one last quote to think about, and this is from the respondents in our surveys. The idea that you can somehow beat it feels like a sales pitch. Now, I think we're all pretty familiar with that, having lived through the GFC and now entering into some fairly volatile times. Aspirers don't necessarily want that, next best thing. They're looking for consistency, simplicity, and education. So, if on your tables, you can start to sort of throw your ideas onto the canvas. There's no right or wrong answer. And then after about 15 minutes, we'll pick out a few people from the crowd to give you an opportunity to share with the group what you've come up with. We'll be wandering around as well if you've got any questions. Okay, unfortunately we have run out of time, but fantastic to see so much energy in the room. Before I finish, we're just going to throw back to the floor. So can I have everyone's attention? It's good to see everyone's enjoying themselves so much. We only have about 5 minutes left, so we're going to get 2 examples from the floor. I think we've got one over in the back corner. If we could just get your name, but your value proposition and the channels that you've decided to focus on.
Okay, so my name is Vinny Warren, and the value proposition for the Aspire Group is provide products and knowledge solutions consistent with their financial literacy. Segments, was that the other part, Matt?
So you've done the value channels?
Channels, so that would be for, so I think digital marketing will play a huge role. So like robo-advice could potentially be very beneficial to people in that group. Mm-hmm. Online content and things of that nature, so things of digital nature.
Now you've actually used the business canvas in the past to help you build your service. Did you find it a useful tool?
Absolutely. So we used the business model canvas to build a new team. And it's really good because we would just use sticky notes, stick it up, and then what we find is that we're able to pivot throughout the journey. So it's been a powerful tool in that respect. So
that's wonderful. Thanks for sharing that. We got one more. I think it was at the Zurich table down the front. Was keen to share some of their ideas.
I think so. There's always good ideas from Zurich.
Absolutely. So if we could get someone from the table just to run through quickly what your value proposition is.
Yeah, my name's...
Sorry, the channel, and this one's important. How are you going to make money?
How are we going to make money? My name's Rob. So our value proposition was educating information for clients, focusing on ease of access to information. How we're going to make money, well, the channels we're going to use are web-based, so internet, videos, webinars, emails, etc. And we're going to make money via giving them a bit of cheese via some free budgeting tools, but then offering a monthly subscription to try and educate them via various pieces, etc., etc.
Fantastic. And that subscription fee is really interesting. The site that I mentioned before, LearnVest, that's basically how they charge. So $19.50 a month for a range of programs. So you can subscribe to 2, and it's $40 a month, 3, etc., etc. But it breaks it down into little chunks that directly relate to the individual. So this isn't about delving into all the detail, but here's just a couple of ideas that we threw up on the board that largely look like some of the ones from over in the States. The customer segment was the aspirer, so Australians, due to regulation, it's not easy to export our services at this stage. The value proposition was an automated investment service with rebalancing using ETFs, but there was also an online progress board and tailored educational content. The channels were online and mobile. Increasingly, everything is about this mobile-first strategy, so making it really easy to access. Customer relationships, automated and self-service. And this is really important because it's a one-to-many. So create one bit of content or one bit of technology that can service many people, highly scalable. But also an advisor relationship, so if they get stuck, they can reach out and speak to someone. The revenue streams, subscription fees and investment management fees. Key activities, sales and marketing, social, and content editor. Now the reason I've got content and social there is, I just want to stress, social is not a strategy in itself. It's actually content marketing. If you've got bad content and you distribute it via social, you're wasting your time. You've got to have great content that's very relevant to your target market, and then social media is just a way to amplify that content. Key resources, advisors, admin staff and IT. Key partners, we're obviously going to need a super and investment platform to manage the product. An investment manager, so it might be that you outsource the investment management or that you do it in-house if you've got the skills and expertise. Editors, content creators, so we're going to create the content internally or outsource that to an external writer. Website developers. Cost structure, if we are outsourcing the content fees, staff costs obviously, tech fees and the investment manager fees depending on whether or not we insource or outsource that function. So from there we then decide, okay, is this something that's achievable? If not, rip it in half, start again with the next idea. So that's it from me. In summary, risk profiling is not enough. It's only one part of the consumer picture. Customer centricity is the only way to future-proof your business. You really do need to put your customer at the centre of everything you do. Develop a value proposition or service that meets your current or aspirational customer needs. So that is, look at your current database, decide if they're aspirers or explorers, match up your value proposition, see if it matches, and if not, develop something new or look at a new segment. Ideas are only as good as their execution. You really do need a robust plan to be successful. And most importantly, start small and don't be afraid to fail. You should celebrate failure in your own business and try lots of little things. Never try something so big that it's going to send you underwater, but if you're not failing, you're just not trying hard enough. So thank you very much. I'd love to connect with you all. We'll be doing an ebook on today's session and distributing that via the AFA and hope to speak to you in the break. Thank you.